All right, very good evening to all of you. First of all, I hope that you have watched those videos on tax implications on capital budgeting, and now in this session we will be taking up a go through of Institute's study material that is provided by CMA Institute under the new syllabus 2022, and the topic that we are talking about is capital budgeting. You can see the title over here, investment decisions, project planning and control. That's the main topic heading, and obviously investment decision is the most appropriate title. Capital budgeting is a set of various methods and techniques that we apply for the purpose of taking investment decision. The ultimate objective is investment decision. So if you go through your institute study material, what is the point of highlight? The basic things what they have explained, how to compute cash flows and other things. Here begins the discussion on what they have emphasized about the different methods and techniques that you have to prepare. Discounted payback period, net present value, then you have profitability index, then adjusted net present value or simply adjusted present value, IRR, internal rate of return, then modified NPV and modified IRR. Then they have talked about non-discounted cash flow methods where ARR, average rate of return or accounting rate of return, is being covered. Then we have some illustrations based on that. Payback period method and a couple of illustrations based on that. Then we have discounted payback period. What is my objective over here is to show you from where the real complications start. So all these initial illustrations are very basic illustrations, and don't even expect that such basic things will be asked in exam. Absolutely not. So I'll tell you from which type of questions you can actually expect that such variety of questions can come in exam. So let us just go ahead and look into this. Basic calculations of NPV, IRR, we don't expect that those things would come in exam. Yes, prepare this part very well. Modified IRR, this is to be prepared very well, and what I would strongly recommend that the videos that I have provided on modified IRR, in fact you should watch the videos on reinvestment assumptions under capital budgeting. And when you look into reinvestment assumptions under capital budgeting, you will come across the videos on modified IRR in connection with that. So don't forget to take a view of reinvestment decisions under capital budgeting, and also look into the modified IRR. Moving forward, what we have, this part, NPV and IRR conflict and resolution. Now see, NPV method and IRR method, generally they don't have a conflict, because if you are going with multiple projects, or say you are dealing with mutually exclusive projects, you have two projects, the one that has higher NPV will also provide you higher IRR. But in rare cases you would find that if you are evaluating two projects, say A and B, A is better from NPV angle, whereas B is better from IRR angle, This kind of conflict will rarely happen, but if it happens, how to resolve that? So NPV and IRR conflict and resolution. Friends, on each of these matters I have given detailed conceptual videos with very nice illustrative examples. Please do not miss out on watching each one of these. So what I'll do is, the playlist for capital budgeting topic I will be putting in a very clear format: the basic videos, the moderate level videos, the tax implication based videos, the advanced concepts, and at the end risk analysis under capital budgeting. So there will be in total 5 playlists that will cover up the concept of capital budgeting in totality. So let me take you ahead over here. So this is all about conflict between NPV and IRR, and then we have this part, comparing projects with unequal lives. Now here comes the concept of annualization. So annualization is again a beautiful concept, a very important concept. Wherever you are dealing with projects with unequal lives, you will have to incorporate the concept of annualization. Moving forward, we have abandonment value. This is basically concerned with the real options in capital budgeting. And so basically if you have abandonment option, now what is abandonment option? Suppose you start a project, the life of the project is 10 years, okay, and when you determine its NPV is coming negative. But suppose at 6th year end, by making some compensation payments, you are allowed to abandon the project. If you are allowed to abandon the project, maybe you work out for 6 years, you get NPV as positive. That means when you are taking the entire project throughout its life, it is resulting into a negative NPV. But if you evaluate the project only up to 6 years and abandon the project at 6th year, maybe there is a possibility that later years the project is not profitable, and unnecessarily, because of the burden of various types of fixed costs, you are just having more of outflow and less of inflow, and you are incurring losses. Instead of facing those all losses, it's better to make some compensation payment and close the project, abandon the project at 6th year, even though the life of the assets was 10 years, but you are just discarding everything at 6th year end. Advantage could be, you will be getting a lot of cash flows from the sale value of various assets. Number one, your commitment towards all the fixed costs relating to that project will stop from that point. Of course, because you are breaking a lot of commitments. For example, you would have employed a project manager for the project life of 10 years, and now you would want to mention very clearly that, see, we will not be continuing with this project beyond 6 years time, and we will have to cancel this arrangement. You will have no choice but to pay some compensation. But in spite of all that, if the NPV when you are abandoning the project at 6th year end is positive NPV, means the abandonment option has a value. What is the value of abandonment option? You can easily work it out. For example, the positive NPV with abandonment option is 1 lakh. The negative NPV without abandonment option was negative 20,000. That means without abandonment option, you were getting negative NPV of 20,000. With abandonment option, you are getting a positive NPV of 1 lakh. What is the value of that abandonment option at the inception? It will be difference between positive 1 lakh and negative 20,000. So value of abandonment option would come to 1,20,000. So that's something really great, and you'll be finding that in my videos I have covered all these matters in as much detail as possible. Next comes a wonderful concept again, inflation adjusted cash flow forecasting in capital budgeting. Now what happens? You are planning a project, and project's life is going to be say 10 years. Now you are estimating all the cash flows based on the current price level, correct? Current price level. But price levels are not going to remain constant. Inflation will affect your cash inflows as well as cash outflows. Inflation will play its role. So with incorporation of inflation, the discounting rate that you are adopting will not be the real discounting rate. It will be inflation adjusted discounting rate. When you are making adjustment of inflation with the discounting rate, the discounting rate doesn't remain the real discounting rate. We call that as nominal discounting rate or money discounting rate. Now there are terms like real cash flows and nominal cash flows. Nominal cash flows are inflation adjusted cash flows. Real cash flows are cash flows based on the prices prevailing now. So basically you are making a forecast of cash flows of coming years, right? You are making a forecast of future cash flows, but those future cash flows, are they based on current prices? Yes, then those are real cash flows. Those future cash flows, if they are assessed after adjustment of inflation, those are inflation adjusted cash flows, and inflation adjusted cash flows cannot be discounted using the real discounting rate. Then you have to apply the nominal discounting rate. Simple point is, real cash flows will be discounted using real discounting rate. Nominal cash flows or money cash flows will be discounted using nominal discounting rate or money discounting rate, which is inflation adjusted discounting rate. This is again a beautiful concept in capital budgeting, and we have a separate segment in my books and videos with respect to this particular matter. So let me take you ahead over here. Now, divisible and non-divisible project with application of integer programming. Now see what happens. Projects may or may not be divisible. Now what is the meaning of projects being divisible? Suppose there is a project and the cost of the project is 20 lakhs, but I have only 10 lakhs to invest. I have only 10 lakhs to invest. Can I participate in that project? Maybe, if not in entirety, I may seek a venturer who can be having a joint venture with me, and with that venturer arrangement, we can go for some kind of arrangement in joint venture and we can plan that project together, a kind of partnership. In such case, a project worth 20 lakhs of initial investment, I have only 10 lakhs to invest. Because the project is divisible, it is possible to invest just 10 lakhs. Projects being divisible and projects not being divisible are two different scenarios, and when projects are not divisible, you will have a lot of limitations in terms of utilizing your funds as well. And there even comes the concept of capital rationing. So capital rationing, the role of profitability index or desirability factor will play its role. Ranking of the project will then be based on profitability index, and until your entire capital is fully exhausted, you are going to keep investing in projects. If the projects are divisible, you will have even fractional amount invested in a project. If projects are not divisible, it will create a complication for you. That time capital rationing can be a little more challenging. Again, we have very good questions and concept coverage within that part as well. Now this kind of question, beautiful concept over here, and the same has been extensively covered in my videos. And if I scroll further, what is given in the next part, social cost benefit analysis, more of theory. My videos doesn't cover much of this part, just the basic thing what you have to prepare from the material itself. And then of course these are questions from the practice segment. Look at all these questions. So many students, they get confused. I'll tell you why. Because they show me this. they show me this social cost benefit analysis, and I just mentioned that I have not covered much on social cost benefit analysis. And then when they scroll further, additional illustrations, they believe that it is from social cost benefit analysis. No, it is not from that segment. Additional illustrations are all from the basic part and advanced part of capital budgeting that we have been discussing all through. These are very good quality illustration. In fact, if you see in this entire social cost benefit analysis, just one page theory given, and therefore I have not talked much about that. Scrolling further, so all these illustrations, what all varieties of illustrations are covered over here, I have explained to you. And if I keep going further, lots of illustrations over here with theory questions and MCQs, and lot of calculative examples even at the back side of the chapter. Now coming to the second segment, evaluation of risky proposals for investment decisions. See, some time back I was talking about inflation adjustment in the project cash flows and discounting rate. Now here we are talking about risk adjustment. So earlier the discounting rate that I was talking about was risk adjusted discounting rate or inflation adjusted discounting rate. Earlier we have talked about inflation adjusted discounting rate, where we were talking about real discounting rate and nominal discounting rate. Now I am talking about not just accommodation of inflation, but accommodation of risk. See, when you are investing in a project, projects are risky, right? You cannot consider investment in a project as risk-free investment. So what will you assess when you are evaluating a project? It is coming to you along with risk. The discounting rate that you should apply should be risk adjusted discounting rate. Now adjusting the discounting rate is not the only way. There are lots of techniques to assess the project performance accommodating the risk factors. One is risk adjusted discounting rate technique, RADR, risk adjusted discounting rate. Another technique is what we call as certainty equivalent technique. Then we have sensitivity analysis and scenario analysis. After covering that, we have simulation techniques, where you will come across Monte Carlo simulation for the purpose of dealing with projects. And then there is role of estimated cash flows, which are EVCF, that is expected value of cash flows assessed from the probabilities. Then comes the role of probabilities and statistical calculations like expected values, standard deviation. And when we are talking about standard deviation, it will be standard deviation of cash flow and standard deviation with respect to NPV. Then we have conditional probabilities and decision tree analysis coming into picture. Conditional probabilities means if the first year cash flow is 50,000, then second year cash flow could be a little more. If first year cash flow is 30,000, then second year cash flow could be little less, something like that. So your second year cash flows are dependent on your first year's cash flows. So those kind of conditional probabilities, and depending on the outcome of one particular event, there will be further outcomes based on that. So if this thing happens, then this, else this. So you will make a complete decision tree along with the plotted probabilities, and through that you work out the NPV of the project. So friends, all this is included in capital budgeting. So what I have to do now is, I want you to have a pinpoint focus on which area in this whole segment, apart from even the videos that I have provided to you, if there is still something that is troubling you, any particular concept, any particular question in your institute study material, which I am just scanning over here, if you have any point of difficulty over there, you just message me in the comment section, and I will see to it that how in the best possible way I can provide the necessary help to you. So all what I had to do in these few sessions for revisionary purpose, I have attempted doing as much as possible. but with limitation of time, I will have to wind up these sessions. So please put forward in your comment section as in what exactly you want me to do further. So some students are also asking me about 2016 syllabus and 2022 syllabus. Let me tell you, as far as capital budgeting is concerned, there is absolutely no difference in the content of 2016 syllabus and 2022 syllabus. Absolutely no difference. Each and everything given in capital budgeting is equally applicable for 2016 as well as 2022 syllabus. In fact, you would see when you compare both the materials, the material given by CMA Institute for 2022 syllabus is definitely much more structured, the one that we are referring right now. But the type of questions, the variety of questions, the coverage of concepts, everything same, not a pinch of difference. So I would want you to mention in the comment section if you want me to cover anything specific, and do mention, and just stay connected with me till your exams. Whatever possible from my side, that kind of help I'll try to render. So I wish all of you all the best. Prepare very well for your exams, and without hesitation you can approach us if you need any specific help. Thank you very much for attending these classes.